The Basel Accords are a series of international banking regulations developed to enhance the stability and resilience of the global financial system. Crafted by the Basel Committee on Banking Supervision, these agreements set standards for capital adequacy, risk management, and supervisory practices among banks worldwide. By establishing consistent rules, the Basel Accords aim to reduce the likelihood of financial crises and promote transparency across borders. Their importance in the modern financial system cannot be overstated, as they help safeguard economies from systemic risks and ensure that banks maintain sufficient buffers to absorb potential losses. As financial markets become increasingly interconnected, the Basel Accords provide a crucial framework for cooperation and trust among nations. The Basel Committee on Banking Supervision, commonly known as the BCBS, is an international body that brings together banking regulators from major economies around the world. Established in 1974 by the central bank governors of the G10 countries, its primary purpose is to enhance financial stability by improving the quality of banking supervision globally. The committee develops guidelines and standards for banking regulation, with a particular focus on risk management and capital adequacy. One of its most significant contributions is the development of the Basel Accords, a series of regulatory frameworks designed to strengthen banks' resilience to financial and operational risks. Through these accords, the BCBS sets out minimum requirements for capital reserves and risk assessment, aiming to promote a safer and more robust banking system internationally. The committee's work continues to evolve in response to changes in the global financial landscape. Basel I was introduced in 1988 by the Basel Committee on Banking Supervision as a global framework for regulating banks. Its primary focus was on credit risk, which refers to the possibility that borrowers may fail to repay their loans. To address this risk, Basel I established minimum capital requirements for banks, ensuring they maintained a buffer to absorb potential losses. The standard set the minimum capital at 8% of a bank's risk-weighted assets, meaning banks had to hold capital proportional to the riskiness of their lending activities. This approach aimed to strengthen the stability of the international banking system and promote confidence among depositors and investors. Basel I marked a significant step toward harmonizing banking regulations across countries. Basel II, introduced in 2004, marked a significant evolution in international banking regulation. Unlike its predecessor, Basel I, this framework expanded the scope of risk management to include not only credit risk but also operational and market risk. At its core, Basel II is structured around three pillars. The first pillar sets minimum capital requirements, ensuring banks hold enough capital to cover their various risks. The second pillar emphasizes supervisory review, allowing regulators to evaluate banks' risk profiles and strategies. The third pillar promotes market discipline by mandating greater transparency, encouraging banks to disclose key information to the public. Together, these pillars aim to strengthen the stability and resilience of the global financial system. Basel III is a comprehensive set of international banking regulations introduced in response to the 2008 financial crisis. Its primary aim is to make banks more resilient by strengthening capital and liquidity requirements. Under Basel III, banks must hold a higher proportion of high-quality capital to better absorb losses during periods of financial stress. The framework also introduces a leverage ratio, which limits the extent to which banks can use borrowed funds relative to their capital base. Additionally, new capital buffers, such as the capital conservation buffer and countercyclical buffer, are designed to ensure banks build up reserves in good times that can be drawn upon in downturns. These measures collectively enhance the stability of the banking system and reduce the risk of future crises. Risk-weighted assets are a measure used by banks to determine the total value of their assets, adjusted for risk. This means that assets considered riskier, like unsecured loans, are given a higher weight than safer assets, such as government bonds. Capital adequacy refers to the amount of capital a bank must hold relative to its risk-weighted assets, ensuring it can absorb potential losses. Liquidity requirements mandate that banks maintain enough liquid assets to meet short-term obligations, helping them withstand sudden withdrawals or financial stress. Leverage ratios compare a bank's core capital to its total assets, limiting excessive borrowing. Together, these metrics provide a framework for banks to identify, measure, and control various types of financial risk, promoting stability within the banking system. The Basel Accords have played a pivotal role in shaping global banking practices. By establishing internationally recognized standards for capital adequacy, risk management, and disclosure, these accords help banks maintain sufficient buffers against financial shocks. Enhanced transparency requirements ensure that institutions provide clear and consistent information about their financial health, fostering greater trust among stakeholders. The accords also promote rigorous supervision and encourage banks to identify, measure, and mitigate risks more effectively. As a result, the likelihood of systemic crises is reduced, contributing to the overall stability of the financial system. Through continuous updates and revisions, the Basel framework adapts to emerging risks, reinforcing its relevance in an ever-evolving banking landscape. Understanding the Basel Accords is crucial for finance students, banking professionals, and investors because these international regulations shape the way banks manage risk, maintain capital, and ensure financial stability. The Accords set standards that influence lending practices, investment decisions, and the overall health of the global financial system. For those entering the finance industry, knowledge of Basel guidelines is fundamental to navigating regulatory environments and assessing institutional safety. Banking professionals rely on these frameworks to comply with legal requirements and to safeguard their organizations against unexpected losses. Investors, meanwhile, use insights from the Accords to evaluate the resilience of banks and the broader market. Despite their importance, ongoing debates question whether the Basel Accords are truly effective in preventing future financial crises, with critics arguing that regulations may not fully address emerging risks or complexities in global finance. These discussions highlight the need for continuous review and adaptation of regulatory standards. If you enjoy this video, don't forget to give it a thumbs up, share it with your friends, and hit that subscribe button. It really helps the channel grow and keeps you updated with our latest content. Thanks for your support. Please tune in for our coming videos on knowledge-based contents.